We are. Okay, wonderful. Hello, everyone. We got a full house. I'm just excited as can be to be with you. I got a little frog in my throat. I think it's going to go away as we get going here, but I feel great and no coronavirus here. And we're just happy to be here. How you doing, Corey?
I'm doing so good. Yeah, it sounds like you're getting a little hoarse, but the cough's gone away. I noticed that last session, so glad you're feeling better.
The cough is gone, and I think as I continue to speak, that old voice will warm right up, and we'll be ready to go. So the first order of business, as always, is let's see if I can get a disclaimer up here. Holy cow, that's a huge disclaimer that got kind of messed up. Let me see if I can try for a better one, guys.
Let's see. We're not yelling the disclaimer at you.
There we go. Yeah, just a nice, easy disclaimer. Just to remind everyone that we're in the business of educating you, which is a lot different than advising you. You know, advising is when I say, "Oh, go buy this," or "I think that this would be good for you," or "Maybe you should write some covered calls, and that'd be a good strategy for you." That's not what we do, but we'll teach what a covered call is, and we'll show people how to do them, and then you can work with your team and your advisor if you choose to. Some love an advisor. I think that's great. Some of you like me like to do it yourself. That's up to you. But
hey, Andy, just let me jump in here. They're saying you're really quiet. Is there any way you can get the mic turned?
Yeah, I can boost myself up like crazy. I
think they're going to love that.
Is that a little bit better, everybody?
Nice.
Okay, fantastic. Oh, much better. Perfect. So that's our disclaimer, and this stuff is risky for sure. And I think this particular group, you've been so responsive that I'll tell you what, I think you've just really taken the lessons well, at least from your responses and the way you've carried yourselves has been just fantastic and been just great. What have you guys enjoyed the course so far? We're not even close to being done with this yet, but hopefully you're enjoying the course. Let's see how everyone's doing with 4 pillars. Everybody, Mary says top shelf. Well, that's a great saying. I like that. I'm going to use that. Top shelf. Okay. Rahesh says pillar number 3. Okay. Awesome. Module number 7. Chris is in. God, you guys are way doing great. Fantastic. Corey, how'd your coaching session go today? I tried to eavesdrop, but I had to run and do a quick meeting with someone. How'd that go? How'd the coaching go?
It was awesome. And I see a comment here from somebody. Is it Astrays? I'm not sure I'm saying that right, but he says, waiting on coaching. So we just launched the coaching program. If you want more information on that, make sure you reach out. Really exciting stuff. We have officially launched, so now we're ready to rock and roll, and it was awesome.
It's the same. It's pricing wise, it's about the same as a 4 pillars course, so it's economical. It's not $10,000 or anything like that, but you can find out, send us an email and get on the waiting list. So there. Oh, you guys are so nice. Look at Milder say we good teachers. Okay, let's just review a trade we did. I did not get filled, Corey. I don't know if you got filled on last week's SPY trade or not, but let's just check in on our GLD trade real quick. The first one we did, and this is a snoozer.
And we can rebuild the SPY trade as well.
Okay. We can go ahead and rebuild it.
It was actually easily filled because the market actually went up just a touch the next day, so you could have easily gotten that price or better for most of the next day, and then it has since fallen down a little bit from there. So we'll take a look at it.
Fantastic. So right here we've got for 418 is when this expires. And we've got about a 99% chance. Don't let those fool you because that's just based on standard deviation. That's based on the past. And as you guys know, the future isn't always like the past. We could have, some crazy thing happen. So, just understand that when you look at this little shaded area of a standard deviation and you look at these percentage, that's based on past. Well, things in the future aren't always like the past, but it does give us a little bit of a gauge of likelihood. Probably better looking at it than not. But as I said, I predicted this would probably be a pretty boring trade. What's important to understand in the Quick Start Lab is that we used all 4 pillars. So I'm going to quiz you guys. When it comes to gold, would you do a corporate fundamental analysis, or would it be more sovereign and personal? What do you think? Let's just enter that in your question box. Yeah, this is a sovereign personal type of deal, right? And this is a very typical bread and butter cash flow trade. Today we're going to do a little different one. I'm going to challenge Corey to find us let's see if you guys can remember the name of this trade. What's the name of this trade? And I'll help you with this. What direction does the stock go that helps us, right? And what are the options that we're using here? And is this a credit or a debit? So let's see if you guys can type that in. So someone says this is a bull put credit spread. That's exactly right. Some people have bull credit put spread. That's fine. As long as, bull put credit spread. As long as you're learning the name, understanding that we want it to go up, we're using puts, we're taking a credit, and you'll notice that this is a very tiny reward, $38 for $462 risk, but you know what? $38, let's see if I can get this right. $38 divided by 462, that's about 8% if I do that right, and this is about a month-long trade we've been in, little less than a month. So it's a very reasonable reward per risk taken, but that is a lot of risk there. But this is a bread and butter cash flow trade, and this is not a trade that'll give us a position necessarily in gold. If it lands here, we might take a position, let some of it get put to us, but this is purely for cash flow. This isn't generally how someone would say, hey, I want to take a long-term position in the GLD. That's just not how this would happen. So do you guys feel pretty good about how this trade was built? Do you feel like you have a basic understanding of it pretty well? Yes, we can move on to a new one. Yes, yep. Pretty good basic. What's the best way to get good at this? What do you guys think it is? What do you think the best way to make this just secondhand would be? Practice. And I love it. Paper practice, not in the real thing. You get in the simulated trading and you practice. And it'd probably a good idea to have one go down and learn how to delta hedge this a little bit. We'll hopefully get one of those. Maybe we'll make a bad trade on purpose where we have to learn to deal with that. Let's do that as review. And then Corey, quickly, let's review our SPY trade. I did not get filled on this.
If I remember right, the market had just closed or something when we were going to put it in. So, but it's the June 19th, and I'm not going to give them the information on this. They'll have to remember what was this trade called. Does anyone remember what our SPY trade was called? Think about direction. Oh, we got a couple of responses there.
Mary's got it. Yeah, this is going to be a bear. And was this going to be beautiful, Theo. Theo even got the debit, right? It's not a credit. It's not a credit because we're not getting credit. We're actually going to send out more money than we brought in on this one. Do you remember the strikes, Corey? Or we can just build one?
We did the 255. We bought the 255.
Okay, so
which was just under the market at the time. Remember when we were building this, SPY was at 259, and we picked a strike that was just below. And now look at where the stock is. It's at 251.
We should probably do a different one.
No, this is perfect because that's the one we bought. It was the 255. I'm just pointing out that the stock was above the strike, and now it's below. So it went. This is what they call. It was an out of the money option, but now the stock has moved below the put. So now it's an in the money option. We're currently in the money on that put we bought, which just simply means it's gone past that strike price to become an in-the-money option. That's a trading term.
Now.
Yeah, it has some intrinsic value.
The way to tell guys if it's in the money or out of the money is you'll notice that the price, this is an important options lesson, is right now the last price on this was $251.83. If you can see my cursor up here wiggling around this last price of $251.83. And you'll notice that everything that is below $251.83 on the put side has no intrinsic value. It just has what we call time value or extrinsic value. But once it begins to go beyond that strike of 251 into 252, 253, now we see that we start having some intrinsic value. What that means is this makes a lot of sense. You know, if you have the right to sell this at let's say 255, and you can buy it at 251.83. That'll give you about $3.21 of intrinsic value. That's about what it's worth. Then we got a bunch of extrinsic. You'll notice on the call side that if you get higher than where the price is, no intrinsic value. It's all time value or extrinsic value. So you'll learn more about that, but let's go ahead and put the other put on. Which one do you want to put on?
And then we sold the 200 strike put. So way down at 200.
That's a wide one.
Yep, that capped our gain potential on that in this trade. So this is a bear put debit spread. We bought contract. In other words, it's a debit spread because you'll notice the pricing differential is money going out. And look at this risk graph. Remember, focus on that kind of turquoise color. As the stock goes down, we make money all the way down to 200, at which point it flattens out. That's our cap on our gain. And this cost us just over $13 at the time. So when we put this trade on, I think it was $13.20 is what I have written down.
Yeah.
So if you look at what the price is today versus what you paid, it shows your gain or loss. Now think about this. We paid $13.20 for the spread. The question of, am I up or down in the trade? Well, what's it trading for right now? And if we look at the price of it right now, it's that differential. Basically, if we wanted to get out of the trade and you can sell this back to the market, what do you have to do to get out? You have to do the opposite of what you did to get in. In other words, you sell what you bought and you buy back what you sold.
So let's look at this right here. So we bought one and we spent, let's just put this in of what we'd get out of this right here. Because last time I think we had a $13 spread. So look.
Yeah, and maybe Andy, switch those. Just flip it around as if we were going to sell this put spread back. So flip the buy to sell and flip the sell to buy. Okay, well, let's get this
show
number. The opposite.
Let's get this number first. So if I'm going to spend $21.21 and then I'm going to receive $5.76, the total amount would be $15.45. Now, Corey's exactly right. If we wanted to get out of this trade, we would just flip this to sell, flip this to buy, and that would get us out of the trade, right?
Yeah, and my point was that we already have our cost, right? If you bought this a few days ago for $13.20, that's your cost basis on this trade. The value of this trade is constantly going to be moving from day to day. So it can go up in value, it can go down in value. If we paid $13.20 for it, that's our cost basis. Here's what we're getting back. If we wanted to sell it back to the market, we're going to get current prices. And as Andy has shown, you're going to get back about $15.45 if we wanted to sell this back and be done with it. So your $1,320 has turned into $1,545. That's if we wanted to get out today. Now, we know that there's a lot more profit potential if we stay in and the stock keeps, in this case, the market, S&P 500, if SPY keeps falling, the value of this spread will keep climbing higher and higher and higher. So it's worth $15.45, but look at how it climbs as the stock goes down, all the way up to where we could max out our gain at 4,000. So this gain right now is a couple $100. Should we sell it back to the market? Probably not, unless we really felt like it was done. If we felt like the market, we don't need protection, the market's good, whatever, I mean, we could sell it back and make a couple $100, but it's probably not why we bought this. We probably bought this for more profit potential and more protection.
So let me tell you why we bought this and review this, because we've given you guys so much in such a short amount of time. There's a lot to remember. So a review here is really important part of the Quick Start Lab. In the 4 pillars of investing, in the last pillar called risk management, we teach something called a protective put. And this is a protective put, meaning that if I owned some of this stock and I was worried about the stock falling, I could buy this as insurance, and you could see that it makes a lot of money. But if you remember from last week, this insurance at $21.21, if we bought it today, goes all the way to zero. And the market's probably not going to go to zero. We're probably going to have coronavirus and some problems, but I don't think we'll see a market of zero. So we said, well, how long do we think it'll go down? We said, well, maybe to 200, might be a place. That would equate on the chart, way, way, way down here to 200. That's a ways out here. That'd be going back to some 2015 pricing. We say, let's just buy insurance from where it is today all the way down to 200. And the reason that's cool is that gives us $5.76 back from what we sold. So instead of spending $21.21, if we got in this trade today, it'd be, 25% cheaper, really. So it's a way to cut that cost basis. And this is really a great trade for what we call a hedge. Let's say that I had a whole bunch of positions that I didn't want to put stop losses on. Let's say that I had a position in Apple, AAPL, and I wanted Apple to go up this way. And let's say I had a position in IBM, and I wanted to go this way. And I had a position in Delta Airlines, and I wanted to go this way. And I had a position in, Kraft Heinz, which I really like, and it go this way. And I know that as long as it goes up, I'm making money, but if it goes down, I'm losing money. So rather, and these guys are going to pay dividends to me, and I don't want to sell them and have a tax consequence, and I just want to keep those positions, but I'm nervous that the market will go down. Well, what I could do very readily, looks like Noah wants to be in here fighting me for the account, and I'm not going to let him have it. That's pretty funny. He just tried to take it over. He doesn't know I'm teaching a class. That's awesome. I'm going to text him. Hey, Siri, text Noah Davidson.
What do you want to say?
I'm in the Mentor Club account for about an hour, buddy. Thanks, period. Sorry. He probably wanted to go in and manage some stuff. So I'm going to open
So one time we're teaching the Quick Start Lab real quick, and this was probably last year, and Andy's phone accidentally goes on, and it starts copying this text message that was all jumbled, and he ended up sending it to Noah. Oh, it was so funny.
It was so bad, and it was, I think it was like PG-13, maybe worse.
Yeah,
it was pretty bad.
It didn't translate very well, but it was hilarious.
Okay, let me get back in here and finish what we're doing. I hope I don't have to rebuild that again. Let's see. I don't think I will. But let's say that I have all these trades and I don't want to mess with them. And so maybe I've got, just for fun, maybe I've got, let's say, 100 shares of this and 100 shares of this and 100 shares of this and 100 shares of this. Maybe what I do for a hedge is I say, you know what, let's make a trade that has a trajectory of down to offset this, right? Let me draw something over here. If I have this graph and I add it to this graph, right here, what would that equal? What would those two graphs be equal to? Well, if one of them's going this way at this trajectory and one of them's going this way at this trajectory, they would neutralize each other. And, one of them's pointing to the left and up, one of them's pointing to the right. Look, that would neutralize each other. So I might take my SPY trade and put this on to neutralize and just delta hedge a little bit, and just say, look, I want to pour some acid on this. I just want to freeze this for a while. And I just want to say, hey, let's just calm everything down in a tough time where I'm really not concerned about making a ton of money on these, but I certainly don't want to sell them. I'd certainly like to, hold them for the dividend that I'm going to get no matter what direction, because these are investments. And I'm not worried about the stock price so much. I'm worried about selling, airline tickets and iPhones and stuff, just trying to protect my price a little bit, just trying to protect myself a little bit. Well, that would be a great reason, I think, for a trade like this, because if I had a whole bunch of positions that had, well, let's show this. This might be a good way to show it. Let me get rid of these, and let me just buy. Let's just buy a whole bunch of stock right here, like this. See? So now, which direction is this one going? We can see that I have a direction going like that, right? Now watch. Which direction is this one going? Right? I'll just move it so it's really pretty. Well, look at that right there. See that? See that? So now the purple line on this one is going like this. See how they're opposite of each other? And if I were to put these together like this, it gives me a nice flat type of line in this area where I just am not going to gain a lot or lose a lot. And I can just be real calm about where I'm at right here with that. So that's really the purpose of us teaching this in this particular one, because this really isn't, I wouldn't call this so much a cash flow trade as just a trade to give me a little safety, that if my stock started to fall, and of course I could juice this up if I wanted, to 2 or 3 contracts. If my stock started to fall, my one little trade here would compensate for the loss. So how many are starting to understand this a little bit better? Now watch this. Sean says, now watch this. I say, a lot too. I try to get out of that one. But does that make sense to you guys right here? We're just hedging. We're just protecting. We're just playing a little defense with this trade. And here's something that'd be really interesting is, let's say you had a 401k and you were concerned because 401ks are mutual funds. You're looking at stock prices. You're not necessarily looking for dividends in that stuff. You're not, Warren Buffett doesn't own mutual funds. He invests in good companies. So think about this. That's great. Dan Long says, I get this theory. So think about this. Let's rewind the clock back a little bit. Before this big mess happened from 340 down to 220. Well, if you have a 401k right now, your 401k probably took a bit of a beating right here in this little area. See, it probably took a bit of a beating. And it didn't happen overnight. I mean, I can't say we saw it coming. But, after the first day or two, we knew something nasty was up. Well, great. You leave your 401k alone and you let this carnage happen in your 401k. But in your Ameritrade account, maybe you throw a couple of these on to pay you now while that stuff falls. And then you take this cash off the table and you've got that cash, almost like you collected an insurance money on the fire of your home, but you still got your home. You still have it. You still have that 401k. Just got compensated a little bit for that downward movement. So, you really could have done this. Now, again, Rahesh says, well, could I do this in my 401k account? Nope. You couldn't do it in the account. But again, watch. They don't have to be in the same account. Watch. let's say that over here I have my 401k and it looks like this, really bad. And then without my company even knowing, maybe I got some with TD Ameritrade or E-Trade or someone, and I have that really cool risk graph that we had that looks like this, right? That looks like this. So now when the stock falls here, I'm really, really sad. But when the stock falls here, I'm very, very happy. And this can offset, or another word would be to what? Hedge. You could hedge this. So while you couldn't do any options in your 401k, your company doesn't have any knowledge or it's none of their freaking business whether to have this over here. Or maybe this is a separate IRA, and you can certainly do this in your IRA that way. And so it doesn't have to be the same account. You're losing a little bit of money on this side, but you're making a little money on this side to kind of ease that pain a little bit. So the big picture in this trade that we were putting on here was to realize that I can make money when the stocks go down to compensate for bullish trades, right? There are ways to profit when the market goes down. And that's the biggest thing to explain and understand, right? Very, very, very. Now, Gary has a great question. And when you get into further stuff here, well, you know what? I'll just show you. In the Mentor Club, we don't have this weighted yet. And there's something called beta weighting. So I'm going to get ahead of myself, Corey. See, this is what I tell everyone not to do. Don't get in the weeds. And here I'm in the weeds. You'll notice right here that we're bearish in our portfolio. We have a total portfolio negative delta of 2154. Well, remember, delta is like the slope of this right here, right? I can take the slope of this right here. Right now, the delta of this is 68, right? 68. So if I look at this and I say, here's a negative delta of 2155. Well, how do these move relative to the S&P? I can hit beta weight in here. I can type SPY in here, and it'll tell me exactly how many shares of SPY I would need to buy or short or get a put on to match that delta up. So I need about 1,000 in the SPY to offset 2,100 in my portfolio. So you'll learn that in Mentor Club, and we'll do that. But Gary Taylor says, very cool. I'm glad you like that, Gary Taylor. That was just for you. And that tells me how much to buy. So as you get into some of the further classes, one of the things I recommend when you're done with this one, if you like it, is start getting serious in that Ultimate Options where we really break down delta in a more scientific and kind of a wonky way of weirdness. So those are our first two trades. One is on gold for cash flow. Right? Whoops. We had a little cash flow trade on gold. If I can find my GLD in here. This is definitely a cash flow trade where we're making money on the decay of time, and it's a snoozer. When you start doing this in real life, you can do more than one contract if you want. If a guy has $4,000 set aside, $4,600, he can make $380, and now you got your car payment, right? This is so awesome. I'm getting text from Noah. Let me know when you're out. I need to work on unwinding positions for tomorrow. So good to know Noah's working hard in the Mentor Club portfolio. So that was the first two. Let's do, Corey, can I challenge you on the fly here? This is a bull put credit. How about we start setting up our iron condor at the end of this thing, and let's learn the other side of this trade. Instead of a bull put credit, let's do a bear call credit today. And that might be tough, but we'll try it. Maybe we'll try.
Are you thinking on GLD so that we can have an iron condor when it's done?
No, we'll do that last. Let's find a different stock to do it on.
Perfect.
We'll do an iron condor separate.
One question that's come in that, as a reminder, we're on that SPY trade that we did on Monday. This is only using options. We're assuming that you could have had a portfolio of stocks or you could have owned some stocks, and we were showing that this could be acting as a hedge. But the only trade we're showing just uses the 2 put options. And the other question is, why do it as a spread? Well, remember, we talked about that we don't think SPY is going to zero. So if you don't need all of that protection, you actually get a better price, a better risk to reward if you're willing to cap off that protection, because you say, look, SPY is probably not going to be below 200. Let's protect ourselves from here to 200, and we'll leave the rest at risk because we don't think that it's going to completely collapse and so forth. By selling that lower 200 strike put, we bring in some money back in. So a couple of things there just to kind of make sure that that's more clear.
Yeah, let's say this. I'm just going to ask everyone, are we buying any stock in this trade that we're looking at here? Let's just give that a yes or no. Am I buying any stock here at all, or any ETF? Nope. This is simply buying. In fact, I can get rid of this. This is simply buying put options at 1 strike price and 1 premium, and selling put options at another. That's it. We don't even have to touch the stock in this instance. So great job, you guys. Great job. And it's kind of interesting because people don't often realize is that these are separate markets. We have the United States right here. Look at this. Texas, California. That's not that bad, actually. Actually, it is kind of bad. I really screwed up Michigan and the Great Lakes. But in Chicago, right here, and then over here, you got Massachusetts and Long Island. You got New York over here. Here you have what we call the CBOE, the Chicago Board of Options Exchange. And over here, you have the New York Stock Exchange. An exchange is just another way for trade. And so this is where the stocks are bought and sold. And notice this is where the options are bought and sold. So I can buy or sell a stock, or I can buy or sell an option, and never the two have to meet necessarily. They can, but this is an entirely separate market over here than the stock market. So that's kind of a fun thing to remind everyone is this entire trade bought, sold, a whole bit. The only time they cross over is if I make a promise to buy a stock and, they make me keep that promise. Then at that point, I'd go to the stock exchange and we'd make a trade there. But it's kind of fun to know those are separate. So everyone, and again, don't have to be perfect in this, guys. You don't have to be perfect in this. But if you're grasping big picture concepts, I'm thrilled. I'm absolutely thrilled if you're buying that type of stuff and you're starting to understand that. So absolutely wonderful. Okay, let's do a trade then. Let's hop in and do one for this week, man. What do you think, Corey? What do you have in mind?
So energy stocks have obviously been a big part of the turmoil, and I think that energy is kind of an interesting place to look in terms of a bear call spread. While I think we can see some rallies, a lot of these big and small energy plays are just going to have some real pressure because oil, the reality is that the oil consumption in the market is just going to be lower for longer. We're not taking flights. We're not doing a lot of things. And it really hurts profitability when your oil's down there at 20, 25. So my thought here and the strategy we're going to show is one, kind of like GLD, where we didn't even need to be precise. We just can't have it fall apart to the downside. Now we're going to take the opposite side, which is we just can't have it make a huge move higher. If it goes up some, no problem. If it goes sideways, great. If it goes down, great. But we can't have it go up a lot, and I feel like this could be an interesting spot. So the stock that came to mind.
Let's look at this sector in general right here, everyone. This is called the XLE, and this is an exchange traded fund that tracks energy. And so as soon as Corey said he was looking at maybe an energy stock, I went right to the XLE, and it was in trouble anyway. our stock market was hitting all-time highs before it fell. Energy, not the case. It hit highs clear back last year in 19, and it was down and struggling, throughout 2019. And now it's really, really fun. We have a big gap in here. So the question is, do we really think energy can get back up here? Probably not. So instead of doing a bull put spread, maybe we bet that energy either goes down, stays the same, or can't fight up very far. Is that what you're saying, Corey?
Exactly right. And if you just think through the fundamentals, remember, we always come back to these four pillars. Sometimes simple and just clear is the best approach. And if you think about energy, think about it from the standpoint of being in business. If you're in business and it costs you $40, $50 to get a barrel of oil out of the ground, and you can only sell it to the market right now at $20 a barrel, how long can you do that? That doesn't sound like, how many restaurants stay in business if it costs them $10 to make a burger and they can only sell it for $5? It just, the math of it, let's not overcomplicate things. Energy companies are in trouble when oil prices are down here in the dumps. Now, there are different components in play, of course, but what I was looking at is a stock like EOG.
This is exciting. I want to hit the four pillars even more on this. So from a fundamental standpoint, this could be really sudden change. Right now, we have two things I think to think about. Number one is we have OPEC and Russia in a supply war where they're pumping out oil. It's like the worst time you could ever choose to have a supply war. But they're pumping out oil because they're trying to get market share and fight and drive the price of oil down. So fundamentally, we have two countries that are major oil players intentionally doing fundamental behavior to drive oil down. So that's a good fundamental reason for us to find this trade. The other thing is with coronavirus, travel by air and jet fuel is probably down quite a bit in terms of passengers. We still have freight, but we don't have passengers. And while we still have trucks, 18-wheelers on the road, I've kind of been sheltering in place. I haven't driven my car in 2 weeks. So it's a good bet fundamentally. So that's the first pillar. Are people buying oil? What's going on with oil? Second pillar.
I wanted to add right there, Andy, why are Saudi Arabia and Russia doing this? Well, in some cases, in Saudi Arabia, for example, they can stick basically a little hose down in the ground and it's sucking up oil. I mean, it doesn't cost them much to pull it out of the ground. And more to the point, I think they're driving down oil to get less competition. What happens when a lot of these U.S. energy companies can't survive? Well, now there's less competition.
Yeah.
And this is one of the things that we like about the big oil players like the Exxons and the Chevrons and some of those are, if they can survive, they can be like Saudi Arabia and Russia on the backside of this, where they have less competition. Maybe they're able to pick up assets at a discount. And oil, I think, can be a situation where you could see it at 20 for a year, and then it could be back up to 70, 2-3 years from now, when a lot of this has worked its way out of the markets, and then all of a sudden there's big price inflation or something like that could really, these things can happen that way. So I agree with your point.
Here's the good news, guys. You hear this term like fundamental analysis, and everyone thinks we got to go get a degree in economics. Actually, by using this pillar fundamentals, we're just using common sense by saying, we are observing these things in the world fundamentally. How can we now translate that into money? So we did fundamentals. Now we'll look at technicals, and certainly it's got some resistance. Often the gap, it either fills or it becomes a resistance point. So we've got plenty of points of resistance in here to play with to help us decide where we're going to go with what strikes. So again, let me bring up the four pillars again. And that's why I'd recommend you continue to study these. Your first 2 weeks in, you guys have done better than darn near any group I've had. I think the urgency of coronavirus has helped, but this is just information. That's it. This is just information. Corey and I have talked about, Russia and OPEC, and now we're going to look at a chart and see some support and resistance levels. That's really going to help us now with our bear call credit, where we're going to choose 2 call options based on this information over here, and then we're going to assess our risk. So what's more important to me than the content of learning this trade is that you guys start seeing us use the 4 pillars of coming to ideas. We say oil. Well, where is it fundamentally? Oh, oil. What does the chart look like? The biggest thing I hope you guys get out of this Quick Start Lab is seeing us use these 2 pillars to build this trade where we can take action over here. So what's cool about this is information on this side, but we take action on this side. We get a position built that will cash flow with reasonable risk management. That's what we're going after, is how do we take this information from the world and turn it into potential cash to go inside our pocket as best we can. Do we have any fans of the 4 pillars here? Yeah, thanks, Theo. Theo says this week's 4 pillars was awesome. See how cool these are, right? Yep. And Deborah, we're going to explain this to you. That's a great question. You can hold on to that for a bit. Makes it way simple to understand. So let's take a look now at what was the stock you wanted to look at, Corey?
Yeah, I was looking at EOG, which is a company that operates right here in the U.S. and shale drilling is more expensive. So to get it out of the ground it costs more for them, which at a time like this is obviously quite painful. So looking at that, similar gaps, notice the similar gap area. And that's kind of what we're looking at, is how can we take advantage of this type of setup to really, again, we don't even need it to go down a lot. We're just going to put on a trade that, as long as it doesn't go up too much, doesn't go up too far, we can make money, which makes it really interesting.
Let's just do a little technical analysis. It's got a bit of a bullish pattern called a couple handle, but that's going to be okay because look, right here, this is called a gap, meaning that we woke up in the morning and we didn't like this stock, right? There's a huge gap. You don't see that anywhere else in this personality except maybe a small one right there. So we look at the personality of this technical analysis. It's this smooth chain, not a lot of volatility. All of a sudden now it's got this huge gap. It's trying to break through this little cup and handle, but I got to tell you, it's hitting a lot of resistance in here. So what we would probably want to do is sell these calls, not close to where it is, but maybe sell some calls way up here, see if it trickles down a little bit, or goes sideways, or fills the gap and hits its head. And as long as it goes down a lot, sideways, or just up a little, we're going to make money in this trade. The thing that's going to hurt us if we have an extreme move to the upside. If we have an extreme move to the upside, we're going to have to manage some risk and make some adjustments. But it's going to take an extreme move to the upside. And how many feel that given the environment that Russia is still fighting, that's not going to happen? Now, here's what's cool. All of a sudden, Russia and OPEC come to a deal, and the President of the United States says, fly away. Well, then this is probably going to boost. That's what we'd have to have that 4th pillar for. It's not there for decoration, but like I say, this is really for sudden change, right? Look, if we say that oil is suppressed right now, fundamentally, and oil is suppressed right now, technically, we should be able to make cash flow by betting that way. If there's a sudden change, which there always can be, that's where we're going to use this pillar. But as long as there's no sudden change, we're about to put some money in our pocket right here. So let's, I'll shut up and let Corey do his trade here. If I can get my
that's
arrow,
awesome.
Let Corey do his trade. So let's draw some lines on some possible strikes first, maybe, that you might like, and we'll see if there's any premium there. What do you like,
Exactly
Corey?
right. So looking at that resistance, I was kind of looking at that same area, that gap area, which is kind of in the mid 50s, and saying, let's see if we can get anything up there above 50-ish. And that's a long ways away, in terms of where the stock is right now at 38. So you've got a big margin of safety, but just look at what it did today. I mean, these stocks are volatile, so they can really move. I mean, it probably moved 5 or 6 points today from high to low. So up above 50 is where I was kind of looking at, saying, okay, up there, I feel a little safer that we shouldn't have some big blasting move higher. I don't see a massive sustained rally here in energy stocks in the immediate term. I know there's some negotiations ongoing and things like that, but I think we're a little safer fundamentally there, that these are going to be struggling for a while. So if we pull up the options, and I was just looking at a little spread that, probably similar in terms of our GLD trade, where we're going to take in a smaller credit.
Okay.
We're actually going to take more risk than reward, but high probability, where we're getting outside of that standard deviation.
Let me ask, 3 months, 2 months, 1 month, 0. Here's our premium. This is a time decay graph. Here's some money for the premium. Whatever that is, it's not linear. It's going to come and look something like this. And if you remember that from month 3 to month 2, that's how much time decay we have. And from month 1 to month 2, it's got a little bit more. But my heavens, I kind of drew this a little bit off to scale. My heavens, there's a lot of time decay. So do you guys remember the milk lesson? Remember the milk lesson? So if we're going to be getting a credit, I'm going to quiz everyone. Are we going to be more of a buyer here or more of a seller here? If we're putting money in our pocket with a credit, we're not going to spend money. We're going to receive money. Are we a buyer or a seller? And you guys want to go long-term or short-term here? Let's see. Sean Stone says milk. I don't remember that lesson. Yeah, if you're buying milk, you want to buy long-term. But if you're selling milk, you want to sell close to expiration, right? So let's remember that lesson. If you are, let's draw the milk cartons again. Here's your little milk carton, 2%. This one expires in 6 days. Here's another milk carton right here, 2%. This one expires in 12 days. If you were a buyer of the milk, which one would you want? Go. If you're a buyer of the milk, which one would you want? And this is for Sean Stone especially, because he's like, milk, what are we talking about milk for? Yeah, 12 days. If you were a seller of the milk, if you were the grocery store owner, which one? Those sons of guns, my grocery store offers for $9.95, they'll deliver the groceries. And I really, I'm in my 50s and I don't want to get sick. And so I've really sheltered in place. So we decided to try out the delivery of the groceries. And I left it up. I didn't specify. I ordered some milk and those groceries. And when they put those groceries on my step, do you think they reached back and got the long term for me, or do you think they gave me the short term, right? Those sons of guns, they gave me that short term milk. So I've been drinking milk like crazy so it doesn't spoil. It does the body good, okay? So that's just a lesson. And how many think I'll probably repeat that as your instructor 1,000 times? So what month, Corey, do you want to go out here and do this like in January of 21 or 2021, or do you think we ought to have Corey go close to this? What do you have in mind, Corey, for an expiration?
I like where their heads are at. I like that short-term expiration. April 17th right there is similar to what we have in the GLD trade. That's what we call a monthly expiration.
So you like this
basically,
one?
Yeah, that's what is that, 15 days away?
15 days. It looks like it's 15 days away. And, we are going to buy and sell, but we're going to look at what we're doing more of. In other words, is it going to be a net buy or a net sell? And if it's a net sell, we certainly want it short term. We are going to buy some options too, but we're going to sell a more premium than we're going to buy for sure. So let's look at these strikes right here.
And I was looking up there. I don't know how much we're going to get. I was looking to be at about 50 or higher. So we want to go up there and look at selling the 50 call and maybe just buying the next strike. Yeah, and
that's not. Let's see what happens with it, because if we get the midpoint here, Corey, if we can get the mark, that's probably not going to be too bad.
Yeah, it's kind of an odd. I don't know if it's a
mark.
Yeah, it is a weird one. I don't know.
Okay, so this is good though, because this is what it's for. Here we see a really odd widespread. First of all, kind of weird to have a 83 below a 105. That's kind of different right there. Kind of a different spread. So we can either choose a different strike, or we can say, hey, nothing wrong with saying we don't like this stock, and we can choose another stock.
And this might be a case where, because the market's closed, it's just giving you a weird number right now, because during market hours, these things would typically be in order, kind of fall in line and be in order and be a little bit more normal. So I'm guessing that mark might be pretty realistic, and that's probably why it's giving you the 35. Is that asking price probably ought to be closer to 60 or 70 or something like that. But so let's use it as an example. Let's say if we were going to sell that one,
and we want to sell this let's sell this at 35 though, not 25.
Yeah, we want to make sure, and very importantly, you can always specify. Remember, as the trader, you're in control.
Yep.
You don't have to accept what the market is offering. You get to say, no, I only want to do it at this price or better.
So right now they're only offering 25, and we're saying no. We want more. We want 35, and we absolutely can do that. And when the spreads are this far apart, chances are we'll get it.
Yeah, and then I was looking at just buying the next strike up, which is the 52.50. And I'd really like for this to at least yield about 25 cents total. So I don't know if it's going to do that.
Let's say we only want, this is at 17. Let's say we want 15. That'll give us about 20 cents.
And there, it depends on how the market moves tomorrow is the reality of this. When the market opens, if the stock's down and we were trying to get 25 cents for this whole trade or something like that, we're probably not going to get it. But if the market was up and kind of against this trade, meaning it was in more danger, then we'd be able to get that. So we're a little bit, it would depend on how the market moves. Remember, we're trying to get into a bearish trade. So if the stock goes up, then the bearish trade is going to get you a better price for entry, because basically it's more dangerous. It's going the wrong way. Yeah. So they would pay you more credit for putting on that trade.
So let me show you something. Gold, if I take a picture of this, which I can absolutely do, here's our gold trade. And I'm just going to take a picture of that risk graph right here. In fact, let's bring this to where it is so we get our nice percentages, and it just looks like $1 million here. So let's take a picture of that risk graph, and let's go to our other one. What is it again? GOG?
EOG.
Yeah, I don't know what it is. EOG. So I'm going to open that clipboard, and we're gonna bring this over here, and you're going to see something that these are exact opposite trades, aren't they? The GLD trade makes money if the stock goes up 150, 151, 152. This makes money if the stock goes down or fails to go up sufficiently. So in the last 3 or 2 weeks, we've now got a trade that can cash flow if the stock stays the same or goes up. Now we have another one that can cash flow, or if it stays the same and goes down, this one stays the same, goes up. So we have a bull put and a bear call. Bull put, bear call. You'll learn it. It does take some practice.
Yeah. And this EOG trade, so looking at this graph, look at where the stock is at right now. Look at that mark. That's
Right
where
here.
that's where the stock is trading right
38
now
bucks.
at $38 per share, 38.25 or what have you. See how we're in profitable zone. That turquoise line is up above zero. That's our profit potential there. As long as the stock is in that range, we're going to be profitable.
So this is the line in the sand at 50. And if you look at our Analyze tab, that's the one we sold is at 50. So we need this stock basically to stay below 50 for how many days? 15 days.
15, yep.
Yep. Which, you know, this might be a really cool one because if it does rise, then we're going to have to do risk management. So I'm kind of rooting for that, actually, that we're going to have to tweak this one because the gold, I mean, the gold was a snoozer, right? We put it on, we're just making the money. It's a snoozer. Maybe with this one, we'll be lucky with EOG. Maybe we'll get lucky and it'll go up and cause us some problems. But based on standard deviation, there's a 90% chance that on the 18th day of April, there's a 90% chance it's going to be below this line. Only a 9% to 10% chance we're going to go. So our odds of making this money based on standard deviation is pretty good. You'd have to take sudden change. If everything stays the way it is, we just pocket this cash. It would take a sudden change for us to have to make an adjustment and lose some money on this, which could happen.
That's right.
You know, there's a 10% chance it could happen.
That's right. And these are all called vertical spreads. Every trade we've shown so far, the GLD trade and this EOG trade are credit vertical spreads. The SPY trade was a debit vertical spread. But the word vertical spread,
Just
and you'll
means-
see that when you go to paper trade, notice if Andy were to click and go to build a vertical spread, show him the click
Yeah.
and show him the build.
Let me explain.
It'll show
we won't explain
a vertical.
We won't explain diagonal and horizontal yet and get in those weeds. But all I mean by vertical is one is above the other. If I go here to this 50 and this 52.50, you know, these are above and below each other. They're vertical. So I could come here and say, gee, I want to analyze or analyze a sell trade, and I want to do a vertical trade. I could build it that way and combine these two and try to get 20 cents for it. So it's just easier to do it separately. So that's the trade. So we can put that on. And I'll leave this in there and see if I can't put it on and see if I can get filled.
And I'm gonna make a note of it so we can come back and
to the same
review.
the same prices,
same strikes and everything.
Okay, now should you do this for real or should you do this in a paper trade account? What do you guys think? Let's see. Christopher Pearson Smith says this is so amazing. It is fun. You're gonna pay. I love every one of you. Joey has a great comment. How much money would I have to have an account to do this? You mean in your paper trade account, Joey? You would need to have $230 because that's the risk that you're taking. So if I circle this right here, okay, in green, you can see that the most risk you're taking here is you can lose $230, and so they would make you have $230 is what that's how much buying power would be sucked up. They would say, oh, this $230 in your account, you can't use that now. You got to keep that right here. Can't spend it, can't withdraw it because you got the $230 worth of risk, and we're picking up $20 if this trade goes through. Now, if someone says, well, Andy, you know, $20 doesn't excite me. Heck, it's going to be 50 cents for the, you know, commission on the trade. You know, what do? Well, you can scale up from there, right? If you want to do 5 of these or 10 of these, it's going to be up to you. But I can scale this up to 10. Now it's going to take $2,300 to do this trade, but I'm making $200, which isn't quite 10% in 2 weeks on my money.
Yeah. And remember that we could even say we only want this trade if we can get 25.
Yeah.
We don't have to stay at 20. So, you know, this
could
be a situation where I might build this as a I would build this as a vertical spread so that both legs go through together or neither one of them fill. But I could just specify, hey, I want a credit of 25 cents or nothing. We just built it showing the two legs to help you understand it. But if you place this as, like we said, a vertical, you get to specify exactly what you want to do. So here he'll show you.
So
there's the vertical.
I've got the same strikes in here, the same everything in here, except I've got to change it to it's got a credit. So yeah, it's a total credit.
So that's good.
It's all good. I just got to make this
up to 25. Perfect.
25 cents. Now watch this. Same trade. See that? It's the same trade. I've just unchecked the separate one. So here I got a vertical spread, right? Selling one, buying the other. Same thing I've got on the top. The only difference is instead of 20 cents, I bumped this up to 25, saying I want 25. Now it's $2.25 to do the trade, and I get $25, which is exactly, well, not quite, a little over 10% on my money. And this is really a pretty good standard, actually. Everyone's got to make their own decisions. But for Corey and I, if we don't do a lot of these in our account together, we do more investing maybe than trading in our account together. But if we were going to do this trade, we would really like to see a 90% chance of probability based on the standard deviation. We like 90% probability. We probably also really like, in this short a time, the VIX must still be pretty high. Of course, we're asking for a lot here, but we like 10% in a month. This is probably twice as good as what I would settle for 5% on 2 weeks, Corey. How do you feel about that? We're going for 10% reward on risk in 2 weeks. 10% on your money at risk in 2 weeks is pretty high. I'd probably settle for half that if it were me.
Agreed. And part of that is a function of the markets, because we're in a high volatility market. So when markets are like this, option premiums are pumped up.
And more, yeah.
And so there's risk associated with that, because we know that the markets are flying around more than normal. But as traders, and here specifically, we're acting as kind of an insurance company, right? You all understand insurance. What do you pay your insurance company? A premium. What do they offer you? Some protection against something happening. Well, we're kind of acting as the insurance company. We're collecting 25 cents to insure somebody else from 50 to 52.50. We're saying, look, we don't think it goes there, and we're willing to accept your payment to give you that $2.50 of protection. Now, we could be wrong. That stock could go zooming higher, go up into those levels, and we're going to have to either take our loss or pull the lever of risk management and say, okay, now we've got to do something to protect our interest here and protect our trade. And that's that fourth pillar of risk management. We wouldn't want to take a max loss in this trade. We would manage the risk down and try to take a lesser loss. But my point being, in this trade, there's more premium than normal. And I think it's great that you pointed that out, Andy, because these are a little different times than normal. I think everybody understands that as we sit at home every day.
Much different times than normal. And so wanting more premium in this environment is not being greedy. Now, this is kind of fun. I've never done this before. Check this out. Wow, look at this. I hope you guys don't mind your names being broadcasted. If so, I'm sorry. Okay, watch this. Let's do speed round questions. So, $230 for one contract. Let's see what the answer to that question is. Speed round of questions. Here we go, speed round. Let me see if I can get this risk profile and EOG. And one contract, that is correct. Let's get rid of these now. So I can place this, because I'm going to place this at the end. So that's one contract. Now how many is it? Now it's 2, now it's 3, now it's 4, now it's 5, now it's 1. So that is correct for one contract. How many trades is reasonable to manage at the same time? Well, it depends on if you have Noah Davidson and have a life or not. That's how many Noah Davidson wants to do. Me, I don't want to do that many. It depends on if you're a trader or investor. I will show you this that's really interesting. If you go to your 4 pillars class, and I'll just see if I have this. Do I have my cash flow pillar here? How many trades is reasonable at the same time? Well, that's kind of, Christopher, I'd say that's up to you and your personality, right? My wife can multitask. I can't. I used to run 2 AAU teams. My friend runs about 20 because that's his business. It just depends on this. But I will tell you this about Warren Buffett that I think is interesting as far as the investor goes. If you look at Apple and you look at Bank of America, Wells Fargo, Coca-Cola, American Express, Heinz Kraft, Bank Corp, JP Morgan, that's 3/4 of his portfolio. 1, 2, 3, 4, 5, 6, 7, 8 stocks make up 3/4 of his stock portfolio. Heck, he's got 1/5 of his money in Apple right now. 21% of his money in Apple, one stock. So, all this other stuff, does he manage all these? He's more of an investor than a trader. So hopefully that helps. Would I suggest margin, Mary? Margin is a form of leverage, and usually you have to have a margin account to short. So I can't suggest, suggesting is into that, out of the education and into the recommendation, right? Suggesting advice. So this is what I'll tell you without suggesting you use margin. I'll say, well, if you want to go short, you're going to have a margin account. Now, whether you actually use that margin, who knows? But a margin account does bring you more choices and more trades you can make. I'll tell you this, margin will increase your reward by double and increase your risk by double. And so a beginner probably start on a paper trade anyway. Okay, so when we sell, here's Ian. So when we sell the calls, this twists my brain. Well, let me see I got to see what the rest of that question said. Let me find you again. So when we sell the calls, we twist my brain. Where is that, Ian? Right there. Okay, let me get the rest of the question. On the calls, are we planning on stock going up? If we're buying calls, yes. If we're selling calls, we're expecting to go down, or why aren't we buying puts? This is such a good question, Ian. Okay, you guys, you want to know, you want to learn a little trick, everybody, on how to do this? You want to learn a little trick? Okay, this is the trick. It's kind of like when you're in school and you had to draw a story problem. So watch this. The best way to know this is the way I learned it, is to draw the money and the guy who receives the premium, right? Here's the cash. The guy who receives the premium 100% of the time, they both start with a P. Premium, that's the guy that makes the promise. So it's just like insurance. Who gets the money in the insurance business? Who gets the money? The guy who makes the promise. What's another word for option that starts with a C? So this guy has the choice. So you start off with that every time on your scratch paper. And pretty soon you won't even have to draw this out. But I used to draw it out because it would help me learn and practice. And there's nothing wrong with drawing a little picture right here. Okay, now watch. If he has the choice to buy, this is going to be a call option, right? That means that if he has the choice to buy at, let's say, $100, let's draw our graph. Well, if it goes to 110, is this guy going to be happy that he can buy at 100? Yes. But if it goes to 90, is he going to be happy? Is he going to be able to brag about that? No. So if he has the choice to buy, he's going to be very, very happy if the stock went up. And this guy's going to be very, very sad. Now watch this. If this guy sells this call, right? He's receiving the money, right? The guy that made the promise, he would love the stock to go down, because if it's at 90, this guy's not going to want to buy it at 100. And what is he going to put in his pocket? Premium. This is such a good question by Ian. Such a good question, Ian. Because I'll tell you something that you're going to learn. I'm going to pull this off so all of you can see it. Because Ian, this is like the Morgan Jeweler Diamond play of the game if you're a Utah Jazz fan. Okay, this is such a good question. Is why not just buy a put if I think it's going down, right, Ian? Why not, if I think it's going down, why sell a call? Why not just do a put right here? I'm going to show you. Because in this instance, the stock doesn't have to move to make us money. In other words, this stock can sit there at $38.29, and we're not trying to make money so much on the stock movement. But watch this, Ian. We are making money on the movement of time. So watch this little yellow line or this little purple line move as I march the days forward. See how we're making money? Look, now we're at $19. Let's just keep marching it forward. Oh, look, now we're at full profit of $25, $24.90. Let's keep moving it forward. Look at that. Now we're at full profit. So what we're really using is this thing right here, Ian. Watch this. I'm getting too wonky, but I don't care because this group's smart. I'm getting paid basically $1.15 tomorrow to let this sit here. This is called time decay. So just like milk, this stuff decays. And someday it will go to expiration. So the reason that I would sell an option like a call is so it can sit there and I'll just make money off time decay, right? Just like an insurance salesman is going to sell you a policy because he doesn't think your car is going to wreck, a person will sell a call because he doesn't think the stock is going to wreck. That's such a good question, Ian. I love questions like that that are so awesome and relevant. How much should we have? 1 to 2% of our account. I don't like risking more than 1% of my account. You know, I think that'd be a better than risking 50% of your account. I would say, Corey, as a risk manager, the number one thing, Matt, that I've seen people do that blow up their account is they get greedy. They see these numbers, and part of my job is to teach you temperament. They see, you know, right here, we'll just go to break even. They see a 94% chance of making money on this. And they see this 25 and they say, oh, whoa, we're going to load up, man. Let's just load up, you know, and let's go for the two. Heck, why not? Let's just go, you know, bat, you know what, crazy. Now we got to trade here. See, now I got to trade. Oh, 20, that paid my house payment almost right there. That'd take care of me right there. Oh, that's a trade. No, it's not, because it's, you know, what is that? $20,000 to make that trade, right?
Right.
And you're not going to get filled on 100 options anyway. So you might, you know, if they think that. So right now, I like the question because it gives us a chance to talk about temperament. Corey, as a risk manager and a teacher, would you say that too large of a position size is the number one way people blow up their account? Would you agree?
100%. They get sucked into that, exactly like you said, that high probability scenario. And think about it from this standpoint as well. If you put on a bunch of high probability scenarios and that's all you do, then really you have everything in that high probability scenario. What happens when the entire marketplace goes wacko? That's what we just saw. And so some diversification of strategies and things like that is very important as well, because if you think, well, I'll just put my whole account, I'll have a bunch of different stocks, but I'll just do this with all of them, and then everything collapses. Now it's just as if you had one massive trade. So some diversification of different strategies, as well as I really like that he's talking about smaller position sizing, 1% or 2% of the account. 2%.
I like that idea a lot.
Not some huge percentage of your total portfolio in this type of trade.
Yeah, and you look at Christopher's question, Christopher Pearson Smith, you know, how many at the same time? Well, I'd rather have 10 to kind of look at once I was good at this than one big one for sure. Hey, Chris says, any chance of homework for the next class? Absolutely. I can give you some homework, Chris. First of all, get through your 4 pillars and do the homework that's in that. But second of all, Chris, let me see if I can isolate you. I probably can't. Watch this. Is there anything that says you couldn't do this same trade with a different stock? So, Chris, give me a stock. Come on, man. I'm waiting. Type one in. Just type any stock in. I'm waiting. Oh, now everyone's button in front of Chris. Okay, so he says ZM. So watch, Chris, practice the 4 pillars on any stock you want, right? So ZM is Zoom video. He's saying, boy, these guys are probably doing really well because we're all doing online meetings right now, right? So maybe you think you're bearish or bullish. It looks like it's dropped back and people lost their mind for a minute. So you decide, am I bearish or bullish on this? And maybe you say, hey, I don't think it's going to get back to 170. And I do a fundamentals and I do a technicals. And I come in here and I say, well, maybe on Zoom, I take a look at it and I say, maybe I'm going to do, a sell here and a buy here. And I bring up that risk profile, and that's kind of ski-wampus me. Why is that so ski-wampus, Corey? What have I done?
You probably have some others selected there, it looks like.
Oh, I do, because we've already got this in the Mentor Club. That there.
Yeah.
And then I start adjusting for how much I want, and I see what works. So, yeah, you start playing with these, and you can do as many of these in a paper trade account as you want. I think it'd be great to do some of that stuff. How do I decide if it's a call or a put trade? Okay, let's look. Let's go back to our EOG, and I'll give you a hint right here. I'll give you a hint on how to tell. There's a hint right there. Right now, let's ask everybody, would you say the fundamentals right now of our world, just globally, sovereignly, are strong or weak right now? Are the fundamentals a happy face or a frowny face right now? So that to give me one clue. Do you think the trend in the market's more upward or downward right now? So that's probably a clue. And so that helps me decide whether I want to be bullish or bearish. As you guys get better, you'll decide on whether you want to bet on direction or time decay. And if you take our Ultimate Options class, you'll learn how to do Vega, and you'll make money on changes in volatility. So there's 3 ways you'll be learning, and be patient with yourself. You can make money on stock movement. You can make money on time movement. You can make money on changes in volatility when you get more advanced, like Corey is, and like I attempt to be probably more often than I should. But it's fun stuff. So that's how you tell. You use the 4 pillars of investing to decide if you want to do a call or a put, right? You let the information on this side dictate how I want to do my cash flow. And the more trades you learn about, the more you'll get a feel for that. That's a really good question, okay? Could the market accept one of the 2 trades? You have something called all or none when you make this trade. And you can set that up. If you want to edit this, and you can come in and you can have all kinds of different limits and different types of stuff, best exchange, good till canceled, all this stuff. Do I want fills only working? There are all kinds, single order. I can do blast all. I can do one cancels the other. I can do one triggers a sequence. Right here, I'm going to do a single order. And that means that since it's a vertical spread, they both have to go at the same time. They both have to be at the same time. Yeah, and that's how we prefer.
That's how we typically prefer to trade this type of strategy, as opposed to what they call legging in. If you tried to get one filled and then immediately go fill the other, it seems like you'll usually lose some pricing in doing that. If you stack them together and you send it together as a vertical spread, now either both the whole package fills or none of it. Yeah. And so if you send it as a spread, they both go together. They either both get filled or the whole trade doesn't get filled.
Paul Kim, this is a great one. Is this vertical trade safer than a single? Well, I'll show you something here, bud. This is a pretty good question by you. If I get rid of this trade, I just got rid of it. That's all right. If I were to sell a call just by itself, so let's go to EOG. And what was that strike again that we sold, Corey, that you wanted? The 50?
50. Yeah, okay, 50,
so let's say I sell that strike and I go to my risk profile and I bring this out here. How far down can I go before I hit a bottom here? In other words, how high can the stock go in theory? Now, I don't think this is going to $600 a share because it's 38, and I certainly don't think it's going to go from 38 to 600 a share.
It's going to need oil. It's going to need oil prices to go to $1,000 a barrel or something.
I'll tell you what, those oil wells are going to have to start pooping out gold bars, okay, or something, because for that to happen, they're going to have to be bringing out something better than oil. but in 2 weeks, I don't see us getting to 600. But really, how far could I take this? Well, it's unlimited. So you have an infinite amount of money you can theoretically lose. I can just keep taking this out forever because the stock could go up infinitely high, right? So by doing the spread trade, I actually can put a bottom on this, right? As I can say, well, okay, we do this one, let's buy this one. And we were going to say we were going to demand maybe 35 cents for this one and maybe like 0.35 cents for this one. And maybe we're going to try and get like 15 cents out of that one, I think is what we said. Now we have a floor because this one that we bought provides us the protection. Now, we could have got 35 cents for the other and been naked, but this covers us. So we're going to take a little bit less money, but to your point, yeah, I'd say that's a lot less risky to do that spread trade than just sell a single naked call. Would you say trading options takes a different risk management mindset? No, Christopher, I wouldn't at all. You want to be like Mr. Spock in all you do. You know, Captain or Dr. McCoy is such a freaking wimp. You know, the reason Dr. McCoy was on Star Trek is to convince everyone that the Klingons might win. Look, every episode of Star Trek is the same. They go where no man's gone before. They face a moment of peril. They get out their phasers. They win, and then you do the captain's log. Every single Star Trek is the same, right? No, go where no man goes before. Where no man goes before. Moment of peril, captain's log, we win. It's the same. So they have to have a character named Dr. McCoy who makes you believe that maybe this time the Klingons will win and Captain Kirk will die. Maybe this time it will happen. So he says, so Captain Kirk says, let's go down on the surface and check this out. And Dr. McCoy says, damn it, Jim, do you need a sedative? Are you crazy? Well, if you're going to go down there, then I guess I'm going with you. And so Dr. McCoy would be the worst trader because he would look at this graph and say, you know what, that stock's going to go through the roof, knowing my luck. I mean, why even take that risk? Okay, now Captain Kirk would be equally bad because he says, look, 90% chance, and since it's me, it's 100%. I can't lose. So he'd be just as bad. But the guy that would be our guide would be Spock. He'd say, according to my calculations, Captain, based on the standard deviation of the stock, we have a 94%, 96 chance of being successful and a 5.41. In the event it goes down, I suggest countermeasures such as a delta hedge to win. Boom, Mr. Spock, we love you. We think you're awesome. And that's how I'd go about that. I don't know why I have to go into a big soliloquy on Mr. Spock, but the risk management mindset is really the same whether I'm investing or trading, whether it's a dispassionate, fearless.
Gary says, what the hell is happening?
what is this?
That's funny.
Eric says that was dang funny. Other people are just like, I love Matt Wise goes, never tell me the odds. I love that, man. Look what Brett just said. Brett goes, Spock equals Corey. Captain Kirk equals Andy. You know, there's more truth to that, Brett, than yours truly would like to admit. Who just said what just happened? Who said that? I got to see that.
Yeah, that was Gary. What the hell is happening?
What is hell happening? So, hey, we promised fun, simple, and real. We didn't say we don't guarantee the quality of the humor. We just guarantee frequent attempts. Would you always do a vertical trade? No, not always. Actually, without this, if you pull this off, that's called a naked call. And if you're married, don't do this at night, on the computer. Your wife said, what are you up doing? I said, I'm looking at naked calls on the internet. Don't look at anything naked late at night on the internet without your spouse, okay? We're getting a little punchy here. But to tell the truth, we have to confess, Corey, you and I do this naked stuff all the time together on Monday mornings, don't we? We meet
Correct.
On Monday morning and we get naked a lot. We love to see.
I don't love how you're wording that, but yes.
we get naked quite a bit. And the reason Corey and I get naked is I like that full 35, but I also have Corey and we feel like we know how to manage some of that risk. But as a beginner, if I ever taught you how to do that, they should probably, say, Andy, you lose your opportunity to teach if you're teaching people naked calls their third week as traders. That's the risk. That's like the riskiest thing you can do is do these naked where you have a call with no protection. So yeah,
right. and that's what naked means is you're
not
selling
covered.
an option, you're making a promise, and you're uncovered.
Yeah, you're not covered.
You don't have a protected position. Now, there are a couple of ways to protect yourself. The easy way, like we just showed, is to buy that option. Some of you also know the covered call.
Oh, I could have the stock.
Yeah, we could have added the stock against a sold call. Now we're in a bullish position because the stock trumps that. But anyway, there's ways to get covered and not naked. And that's basically what it means. Naked is another word, another way to say uncovered.
I kind of like the little speed round of questions. We got a bunch of questions in a row, so I just took a picture of it. That was kind of a cool speed round way to go. Awesome stuff. Hey, are you guys having fun when you learn this too? I hope you're relaxed. Look, I know there's a lot to learn, guys. I know there is. There's a lot. That's why we're here. That's why we're doing it. So enjoy it. Hey, we're getting thumbs up. We're getting stuff. All right, Ian's giving me the thumbs up. Well, you had such a studly question that we have to give you a thumbs up on that. That was the Morgan Jeweler Diamond question of the day, man. That was good stuff. So, yeah, it is a heavy load, Ruth. It is. But it's like anything else, the more you spend time with it, the easier it gets. So just a great job on persevering. Can't spend enough time. I may think that it'd be worth going through the 4 Pillars course more than once, by the way. A lot of people go through it. Yeah, a lot of people go through it quarterly or yearly, right? It's a good deal, fun stuff. It's just, let me warn you, the thing you got to watch is your temperament, because when you look at 94% 6-9 chance of success in this trade and only a 5% 31% chance it'll go bad, just understand that 5.31 is really there. If you do this 100 times, you'll have 5 of these that you're just so just understand that, wow, this is like way cool way to make money. Always have that good temperament and risk management. Hopefully this one gets up into here. And the best way is like pull half the money off, rip the Band-Aid off, get out of the trade, take a bit of a loss, start with the smaller your position size, the easier this is to sell at $74 and say, I lost $74 on that one. I'm getting out. I can handle a $74 loss, right? That's the best way. Just rip it off in your paper when you're first learning. And then you can say, you know what? I could delta hedge this. So let's finish with this. So at this point, right here, I'm going to blow this up big. Can everyone see that this line is sloping down? Can everyone see the line is sloping down? Did I have everyone see that? And if I take this little price slice, this little thing that I can grab, move around, I put it right on today's price. Okay, watch this. And I see I have a delta of -3. Does everybody see this delta of -3? Okay, that means that if it goes up $1, I'll lose $3. But if it goes down $1, I'll make $3. And that seems to be it. 12, go up $1, down to $8.50. 12 down $1 here. So yeah, that seems about right. Now watch this. If I take a share of stock and I say, you know what, I think I'll buy a share of stock. And what's the delta again? 3? Something like that. So let's buy. Look what I did to that risk graph. Look at my delta now. It's 0.01. See how I just froze that? Now it goes up and down. I'm down $3. See? So anytime I don't like what's happening and I just want to freeze the trade for a minute, that's called a delta hedge, where I just simply looked at the delta. Look. -3 delta. Oh, I'm scared it'll go down. I want to level that off. Great. Take the number that's in the delta, -3. What's -3 and +3? -3.125 and +3.125 is 0.0125. So yeah, it just takes out the 3 right there. So I just simply hedge -3 +3. Whap. Now I'm in control, right? I'm in control. So you'll learn more about, delta hedging. Hopefully we'll get the chance to to maybe do a little delta hedging on this one. Maybe I'll call the Russians and pull a few strings and say, hey, Gorbachev, who's the guy in charge over there? I don't remember his name.
Vladimir.
Vladdy. That guy goes shirtless.
Gorbachev. That was
wait, you tell how old I am, right? Yeah, Putin. Gorbachev. I'm back in the Reagan years when I was a Gorbachev. I say, Putin, I know you're probably out doing a shirtless, he did a shirtless magazine, right? Like a GQ thing. Hey, Putin, I know you're doing the KBG shirtless thing, but could you yank the oil war for a bit so I can get a pop in EOG for my besties in my quick start lab? Think he could go for that? I don't know. We're getting punchy.
You know how you knew that he
Putin.
did that
Stalin. Emmer says Stalin.
So every year we do a Christmas party where we do these crazy white elephant gifts.
Oh, we don't want to talk about that.
And one year we had, the Russian calendar with Vladimir Putin and all these different pictures and things was one of the gifts. So that was funny.
The pillow with my face on it that damaged Noah's son for life. They had to put him in therapy when they took it home. So, all right, guys, we have so much fun doing this. Fun, simple, real. Work on your 4 pillars. Keep it on paper. And in reality, on a more serious note, this is a really fun way. Once you get this down, this is a fun way to get some cash flow, right? This is like legit fun way to get cash flow. So now we want the stock. Let's get the name of it. We would like the stock to go which direction, everyone? Which direction would be good for this trade? Which direction? Bearish or bullish? Everyone. Yeah, bear. Are we doing puts or calls? Puts or calls? We're going bear, call. Is this going to be a net credit or a net debit? A net credit or a net debit? So it sounds to me like this would be a bear, call, credit, spread. Bear, call, credit, spread, which is the opposite of our gold trade, which is a bull put credit spread. So there they are together. And maybe what we'll do before we're done, we'll work next time we meet. We'll manage the risk on this more, and hang out more with managing the risk on this. But great job by you, Corey. I'll see if I can get this filled. Let's show them how to do the order. So I'm going to come in here and I'm going to say on EOG, I want a 50 strike, and I want to analyze vertical.
Notice he's on the call side, on the left side, and he just clicked there and went to a vertical spread.
Vertical spread. And I want to get 25 cents for this, or I'm not doing it. I want 25 cents, not doing it. 17th of April, 50, $2.50 strikes. That's going to be a $250 risk minus my premium. So that's going to be a $225 risk. Yep, $225 risk minus my premium. Now, right click, confirm and send. It's going to say sell one vertical EOG to open the trade, right? I'm going to sell to open. And look at this right here. It's going to give me a credit, okay, minus $1.30 in commissions. And I'll tell you, if you, in my paper trade account, in my real account, if you have a sizable account, they'll do this for 50 cents or whatever you negotiate. So in my other account, I wouldn't be paying no $1.30. I'd say, hey, that's a 50 cent. My risk is going to be 225. So that's how much buying power it's going to take up. They're going to make me freeze 225 of the account. So of the $800,000 in buying power, it just went down $225. And we're going to get a credit of $23.70. If I want to tweak that, I edit it. And I say, okay, everything looks good. I want this as a single order. Okay, confirm and send. One thing I do want to do here is this is good for the day. I'm going to make this good till canceled. And that way, instead of just being good for today, since the market's closed, now it'll be good until we're done with it. So I'm going to hit confirm and send. And that order will sit in there working. I'll have to tell Noah. He'll say, what are you doing? I'll say, hey, we're doing a bear call credit spread. That's what we're doing. So there you go. Okay, guys, great jobs. We love you. Mary says, you can negotiate fees. You better believe you can. I call up Ameritrade or someone like that. I'll say, hey, I've got $100,000 in this account. I'm thinking about moving it over, but golly, your commissions are high. Any love you can give me? You bet. They want that money under management. You'll be surprised. You name a competitor, say, yeah, Interactive Brokers is doing this. Ameritrade will let you trade commission free on stock now. Most of them don't even charge commissions for stock. Say, hey, I want 50 cents on my options or something. So awesome class, great stuff. I won't forget to text Noah. Thanks, Tom. Great session. You guys are so fun. Awesome next class time is I don't know what time zone you're in.
Monday,
but I think
noon Eastern, which would be 11 o'clock a.m. Central, 10 o'clock a.m. Mountain.
You're all over that. Yep, we're mixing them up because some people are all over the world and want different times. So that's great stuff. Sorry for the yes, Dan. In fact, that's going to be the last one we do, Dan. So we're building to that for sure. Brett wants to catch up and look at the gold strikes again just before we sign off. We can pull off our stock and look at those gold strikes. We got a 131 and 136. Short is 136. Long is 131. You guys are awesome. All right. Take care, guys.
Good job, everyone. Keep after it. We'll see you Monday morning.
Yep. And Ruth, I'll tell Tom you appreciate it. He's my personal accountant. He's the best. So great job there, Ruth. We'll keep you in the loop. We'll see you guys. Have fun.